I've lived long enough to see the world change in ways nobody could have predicted. Technology exploded, markets globalized, information started moving faster than lightning. But despite all that, the fundamentals of building wealth, real, durable, lasting wealth, haven't changed at all. They're the same today as they were when I bought my very first stock at age 11. And let me tell you something, if I had simply bought an index fund at 11 and held it for the rest of my life, I would still be a very rich man today. Not because of brilliance, not because of luck, but because time plus compounding plus consistency equals inevitable results. People often come up to me and say, "Warren, what's the secret now? What's the modern strategy? What's the 2025 trick to getting rich?" And I always smile because they expect some new tool, a complicated model, maybe even artificial intelligence or a fancy trading algorithm. But here's my honest answer. The new world didn't replace the old principles. It simply gave more people access to them. In today's world, anyone, literally anyone, can own a piece of the world's greatest businesses with the press of a button. When I started, investing required phone calls, paper records, expensive brokers, and a lot of hassle. Today, you can buy a fraction of Apple or Coca-Cola while you're waiting for your coffee. That convenience should be a gift, but instead, people let it tempt them into stupid decisions. Fast access makes fast mistakes. Let me be very clear. Wealth doesn't come from activity. It comes from inactivity, from patience, from allowing the right decisions to compound untouched. Now let me talk a bit about what makes money grow. Most people think the best investors are the ones with the best analytical models or the fanciest degrees or the most advanced software. But that isn't true. The best investors are the ones who can stay calm, rational, and emotionally detached when everyone else is losing their minds. When markets fall, people panic. They think falling prices are a sign that something is wrong. But falling prices, to me, are a sign that things are finally on sale. If you walked into your favorite store and everything was marked down 30%, you'd be thrilled. But when stocks fall 30%, people run for the exits. It's the same item. It's just cheaper. But emotion clouds judgment. Let me tell you, your temperament matters more than your IQ. I've met thousands of brilliant people who cannot invest well because they can't control their impulses. They chase trends. They follow crowds. They panic at the first sign of trouble. Investing is not a game of cleverness. It's a game of character. Here's another lesson. Don't try to predict the market. I've never met a person who can time the market consistently, not once. If you try to guess when to get in and out, you will miss more opportunities than you capture. Instead, do something far more boring but far more reliable. Invest every month no matter what the headlines say. That habit alone could make the average person financially independent. Let's talk about the businesses themselves. When I choose a company, I look for something I call a durable competitive advantage. Now, that's a fancy phrase, but really, it just means something simple. A reason why the business will still be strong 10, 20, or 30 years from now.